Welcome back to the channel. I've got a very special guest with me today. I've got Alessio Rastani of his channel, Alessio Rastani, and his website as well, leadingtrader.com. Thanks so much for jumping on today. We've got a lot to cover. Thanks again, mate.
Yeah, thanks, Jason. Good to see you.
Alessio's details will be in the video description, but Alessio is someone that I found in the first Bitcoin bull market and a voice of reason. And I've wanted to have him on the channel for some time. So we've finally been able to figure this out with our time differences around the world, with our traveling lives. But Alessio, today we're seeing the stock markets coming up to some critical resistance levels, some of those areas that people have been waiting for. That's what we want to dive into in today's video, and then also look at some of the other macro cycles. How about we start with the stock market, and of course, just a little bit about yourself as well, in case some people haven't seen your channel. You've been around a long time.
Thanks, Jason. Yeah, I'll keep it short. Essentially, I've been analyzing the markets. I mean, that's my main thing. I'm really fascinated, and I'm really interested in the analysis, mostly technical analysis of the charts of stock markets, Bitcoin. Those are the two I mainly focus on, and sometimes and gold and silver as well. I cover actually a lot of markets, but those are the three I mainly focus on. Again, stock markets, the S&P, and then Bitcoin and gold and silver specifically. So the one major thing I focus on, which other people probably don't, is mostly Elliott wave theory, which I can see your audience now saying, "Oh my God," rolling their eyes, saying
they're into it. Some of them are definitely into it. So yeah,
it's okay. By the way, if there are people actually who hate Elliott waves, that's okay, because I used to hate Elliott waves myself. So there's always two competing interpretations, and that's regardless of Elliott wave theory. Any chart you look at, regardless of Elliott waves, it could be any method you use, you're going to have different interpretations, you're going to have different possibilities. Why? Because there's risk. Risk is built into the charts. Uncertainty, chaos is built into the chart. And that means, therefore, there's subjectivity built into the chart analysis. And secondly, that's why if there's subjectivity, that's why all analysts, different analysts, will disagree, regardless of Elliott waves. It could be any methodology. And third, why we need to change our perspective from time to time once we know we're wrong. And that's, again, with any method of analysis you use. It doesn't have to be Elliott waves. Sorry.
I think 2022, 2023 has been a perfect example of how people have interpreted something that actually wasn't there. The bear market, which has now turned into a bull, and they're still considering it a bear. Speaking of which, you've got some pretty good charts there to have a look at when it comes to the stock market. So if you want to bring that up now.
Sure. I mean, before I bring up the chart, Jason, let me just put the context in the sense that I've been bullish in the stock market since the beginning of the year. There's a number of things happening at the start of the year that made me very bullish on the market, and I've consistently remained bullish since January.
All right, so here is the chart of the S&P 500 with a lot of colorful lines. And just to back you up on that point where you were talking about being bullish on the market, I do remember seeing some of those videos of yours early this year.
Oh, thank you.
And it's a tricky time. Most people were very, very bearish, but it takes a lot of guts to see it and call it how you see it and continue on with that analysis. So what have we got here? We've got red, yellow, and
so
blue.
What we're seeing here, this is a chart. This is the weekly chart of the S&P, and the indicator that I put on is called sigma. Sigma, as I said, I developed this indicator a long time ago, and basically, it's basically sigma is a measurement of standard deviation. Okay, that's what this is, standard deviation. So you can say the blue zone in the middle is like the mean average, and the yellow and the red are standard deviations away from the mean. Does that make sense? So, in other words, what I want us to pay attention to is whenever the price on the weekly chart moves into the red zone, which is basically the higher standard deviation, the standard deviation away from the mean. Jason, can you hear me?
We're good to go.
Okay. Yeah. So let's just give an example. Notice what happens whenever the price of the S&P moves into the red zone. This happened I believe this was a few months ago when the S&P rallied. This was this year. And notice over here, can you see this red circle? So you can see what happened. It did
cut out for a second, but it didn't affect the message that you've got there. So it did move away, and we hit the red, and now come back to the yellow and the blue.
Yeah, so when it moves into the red zone, look what happens. Price then pulls back to the blue zone. there's a drift back into the blue zone. You can see this pullback. Okay,
Yes.
let me show you another one. Here's one happened, I believe, in the spring of this year. There it is. You can see it moved into the red zone. I'm trying to just point out this red zone here. That was the S&P moved into the red zone. And notice what happened later. It then pulled back from that red zone in to the blue zone. Actually went further lower. You can see it pulled back further lower. Let's move to another one over here. By the way, you can also notice what happened in the lower red zone. This happened, I believe, last year. Yeah, September, October last year. It moved into the red zone and then notice it pulled back to the mean. Okay. So
Mhm.
you basically, the probability increases. This is the point I'm trying to make out. The probability of a reversion to the mean or a pullback increases whenever price moves into the higher sigma, the red zone, the further standard deviation from the mean. Look what happened in August of last year. Notice moved into the red zone here. There it is.
Mhm.
Okay, and then what happened afterwards? You can see after we moved into the red zone. Okay, I beg your pardon. Let me just get the circle again. After we moved into the red zone, we then pulled back. We drifted back into the blue zone. Actually, went even lower as well. Okay. Notice, by the way, when it's notice here when it moved into the red zone here in the lower red zone, we then snapped back. We snapped back into the blue zone again. So there's a tendency, there's a probability for price to snap back to the mean average every time it moves into the red zone. Okay, here's one over here. If you look over here back in 2021, when it moved into the red zone, the higher standard deviation, it then snapped back to the blue zone again, as we can see. There, it
Mhm.
went back into the blue zone. Okay. Now, notice. Sorry, you're going to ask me something?
Yeah, I mean, maybe you're getting to it, so sorry if I cut in,
Yeah.
but I was looking at the all-time high. It got to the yellow zone,
Yes, got to the yellow
January
zone. You're
2022. Yep.
yes, January to the yellow zone. But the one that interests me the most is the red zone. So I tend to ignore the yellow ones purely because it doesn't have a statistically, shall we say, it doesn't have a statistical significance in my perspective.
Mhm.
The red zone has the really interesting things. In other words,
So what are you using
yeah.
this for then?
Mm,
If we're not looking at it in the yellow zone, we're
mm.
just looking at it for a kind of weekly pullback or a
Basically,
correction,
it
whether it's
tells
a
me.
rally. Yeah.
Yeah, I mean, basically, for me personally, again, everyone is different. What I prefer to do is whenever price moves into the red zone, I like to adjust my risk. So if I'm
Mhm.
long and price moves, for example, if I'm long here and price moves into the red zone here, so a trader could decide at this point to lower their exposure to the stock market or whatever the market is.
Gotcha.
So a
Yep, makes
trader
sense.
who is long, so let's say a trader has been long here, yeah, in the middle zone
Mhm.
here. When it moves into the red zone, they can start to maybe sell. Again, the indicator does not tell you to sell, but this is something a trader can decide on their own perspective,
Sure.
based on their own methodology. So a trader could decide to de-risk, in other words, to lower their exposure on the long side. Not to short necessarily. I'm not saying shorts because that would
Mhm.
require a break of support, but it could at least lower exposure and sell some of their long positions to reduce risk. Same thing here. Price is moving into the red zone. Again, almost into red zone right now, almost reached it quite recently. So this is a region of danger, a region of
Mhm.
risk where, again, I'm not saying that people should sell. All I'm saying is it's a region where a trader could decide to de-risk, to reduce their exposure slightly,
Mhm.
um, maybe take off some long positions. And again, this is completely dependent on them. I'm not saying they should do this. I'm not recommending that people
Totally.
should.
We've got all of the disclaimers. This isn't
Yeah,
financial
exactly.
advice. Exactly.
Yeah,
Yeah.
exactly. All I'm saying is that it's completely based on the perspective of each person.
Mhm.
But I
Mhm.
do think, purely from a chart perspective, all I think is we are in a region of danger, of high risk. Uh, Price is overextended. We're reaching the upper sigma zone, the upper red sigma zone, which is
Mhm.
just under 4,600. It's just near 4,600, near 4.5, just near that 4.5. Well, the region we just reached,
Mhm.
like the region we just reached this week, as we're making this
Sure.
video, we are in a
Yeah.
region. We're getting very close to that danger zone. What does this mean? It means that odds are increasing for us to see a pullback. A
Yeah.
pullback at the very minimum pullback I'm looking for is back inside the blue zone, which would probably mean somewhere in the region of 4,400, 4,500, 4,400. Could it go a bit lower than that? Yeah, of course it could. But the minimum expectation I have is for a pullback to the blue zone, which would mean 4,400 at least in the next
Mhm.
several weeks. Um, that's basically my main point in this by showing this chart.
That's super clear about what the expectations are in, I guess we could call it the shorter term when we're looking at the weekly
Yeah.
chart.
Mm,
It's pretty clear we're going to get some sort of correction,
mm.
but from what you're seeing and what I'm seeing, I don't know if we're going to get that significant correction, something past 4,400 or 4,200 points
Mm.
that a lot of people are expecting, because a lot of people missed out on the bottom
Yeah.
and the higher low and the March higher low and the May higher low. And so I think they're going to miss out on that opportunity. But yeah, according to what you've got there
I
in
just
the
want to make
short
something very
term,
clear. Yeah,
yeah,
I just want to make something very clear, because people may think I'm bearish, like I'm long-term bearish. I'm
of
not.
course,
I'm not long-term bearish. I could say basically, I would say I'm short-term bearish in quotation marks.
cautious. Yeah,
Cautious. I would say short-term cautious. I'm expecting a pullback or retracement down, 4,400 minimum. But you're absolutely right. It could go to 4,300. I don't see why not.
it's barely
Yeah.
5%. So
Yeah.
it's really very
Yeah.
insignificant pullbacks in a grand
Yeah.
scheme bull market, which leads me over to say a bigger time frame, the macro here.
Mm.
I just want to get your thoughts again
But also, I
on
just want to add that long term for the rest of this year, I think once that correction is done, once that pullback is done, let's say 4,400, 4,300, maybe even the lowest part, I would say it really has to stay above 4,200 though for me to remain bullish. But I remain long term bullish, at least for this year, going into the beginning of next year. So I still think long term for the stock market, when I say long term, at least 6 to 12 months later, I'm remaining bullish. I'm remaining for higher prices, much higher levels. I just think in the shorter term, in the next few weeks, there's a we need to be cautious for a pullback or retracement to the levels we
yeah,
just talked about.
which is even better segue into
Sure.
the macro cycle that I wanted to have a
Yeah,
look
sure.
at briefly with you, which is called the Benner cycle. I've had this one come up multiple times at my end, and I saw
Yeah.
you did a great video on
Thank
this
you.
on your channel as well, which has gone absolutely ballistic over there. So, guys, if you haven't subscribed to Alessio,
Thank
links
you.
are in the video description. You know where that to find that. This lines up with a lot of macro cycles that I'm looking at. Can
Yeah.
you just explain where we are? And I'll point to it here on the chart. People can
Yeah.
see this as well.
So
Yep.
people who haven't seen that video, very simply, Samuel Benner was a wealthy farmer back in the 19th century. He got wiped out in the panic. I think it was 1893. I'm not, or 1873. Yeah, sorry, 1870s, or early 1870s. I think it was.
Long
He
time
got,
ago.
yeah, a long time ago. He got wiped out, and he lost almost. I think he lost everything. And interestingly enough, he became fascinated with cycles. You think someone like that would be completely broken and he would never think about the markets ever again. Um, but yeah, he got interested in cycles, and he basically found a pattern that occurs as a series of patterns that occurs in the markets. One larger cycle, one minor cycle, and basically that's what you see here on this chart. He drew this chart based on his pattern of cycles. He drew this in 1875. In fact, people can see his signature on the bottom right. And this is published in a book. I forget the name of the book, but anyway. And he says this is interestingly enough. There's a little line he says above this chart. He says this is the periods when you can make money, presumably with
Mm,
the bits when the prices when he sees the line is going up, that's when you can make money. And then when the line is going down, as you can see in the cycles going down, that's when the bear markets are going to happen, and you want to be extremely cautious and obviously be out of the market during those periods. According to Samuel Benner, not according to me. According to Samuel Benner, you want to be long during the bullish cycles and you want to be out during the bearish cycles. Now, it's caught some interesting tops and bottoms. Some of them are notable, like the 1927 top, which obviously came 2 years. By the way, something to mention here as well. These dates, these numbers, or the years mentioned, they refer to the completion or the end of the years, not to the beginning. So when it says 1999, that means the end of 1999. When it says 2019, he means the end of 2019, the beginning of 2020. Okay, something to bear in mind. So, for example, just have a look at a couple of examples. 1927 is the first cycle, the one of the first ones that came just, I would say, a year and a half almost, or about 2 years before the major 1929 stock market crash of Wall Street crash of 1929, and then a major bear market. As you can see, it went. The line
mhm.
shows it went all the way to the end of 1931, which is correct as well because the bear market
Yeah.
cycle of not 1930s. That happened. That actually ended in 1932, if I'm not mistaken. I think that was correct.
Yep. I think
And
it's
then we,
yeah.
yeah, and then of course, let's just mention that the 1999 .com crash, which is absolutely bang on. That started at the end of 99 or the beginning of the year 2000, which is now he shows it as ending sometime in the 2000s, almost right. Yeah. He
Mhm.
also was absolutely correct on the 2007. If you look at the minor cycle,
Mhm.
there's a minor cycle right there in between
Through
2007.
the middle of it,
Yeah, in the
and
middle.
where the B is pointing. It's got this little B, and then it says B are years of good times, high prices, and the
Yeah,
time to sell stocks and values of all kind.
yeah,
2007, perfect time.
yeah,
1999 would have been another great time.
yeah. Of course, he
Yep.
was wrong on a few. I mean, when I say he was wrong, his pattern, his cycle pattern, got it wrong on 2016. That was a good year to buy, not to sell. But I mean, majority of the time, it seems to be correct. I mean, the 2021, the 2019 was interesting because that came because if you interpret 2019 as meaning the end of 2019, beginning of
Yeah, of
2020,
course.
that was
Yeah.
right at basically at the very start of the COVID
And
pandemic crash. Yeah,
yeah. Well, the
uh,
peak was January 2020, and
yeah,
so look, if you're selling a month before on a macro cycle,
yeah,
like that's really really good going. I'll mention just at the beginning, just to have a look
yeah,
there,
sure,
where you got 1926, 1927, those years in which panics have occurred, and good times. This could almost be. It lines up reasonably well with the 18.6 year real estate cycle. So when we look
yeah,
at land values, the land actually peaked around 1926, I think. So land values peaked and they basically plateaued, whereas the stock market kept going into 1929. And that was all on the back of a lot of easy money that kept going at that
yeah,
time. And there was a couple of other things that happened with the government at that time that allowed more and more speculation. But essentially,
yeah.
it's almost bang on track with the land cycles peaking.
Yeah, you're absolutely right. Yeah, very good point. Now, if this
Yeah.
cycle repeats itself, that means if the cycle is correct for the next one, so that means his cycle is saying we could be due for a bullish period from the end of 2023
Mhm.
to the end of 2026. Personally, I think the bullish cycles started way back at the beginning of 2023 anyway. There's always a little bit of, it's not going to be
Yeah.
100% perfect, obviously. So I
Especially
think
when
we're
you
already,
write it in 1875.
exactly. And you got to
Yeah.
give him some credit. So, yeah, so if that's correct, we are in the bullish cycle already from
Mhm.
2023 to 2026. Personally, I think that bullish cycle is going to finish. I think the current bullish cycle is going to end sometime before 2026, maybe next year, 2024, maybe 2025. And then we're due for a bear market. I think he's right on the bear market crash, which is going to end sometime at the end of this decade. So
Mhm.
probably by the end of this decade, going to the 2030s, beginning of 2030, we could be due. We could be in a long-term bear market. Not now, but as I
Mm.
said this before, probably from next year or probably from the end of next year, 2024, 2025, we could be starting a major drop, stock market crash, um, which could complete by
Sometime
the
after
end of
that.
this decade. I mean, that bear market is going to be brutal. That bear market is going to be
Mhm.
phenomenally brutal. Not just because of this chart, by the way. I'm not just saying this because of this banner cycle. There are many other factors which point to a long-term depressionary bear market cycle. But this seems to corroborate that.
I tend to agree that the next crash is going to be catastrophic.
Yeah,
And I think a lot of people will be caught off guard because they've been expecting it in 2020 and then expecting it in 2022 and then expecting it in 2023. And there's that whole psychology, which we talked about on your
yeah,
channel as well, that they're going to see us continue up and think, well, hang on, it didn't happen. So it's never going to happen, which happens every single cycle. But I think it's got a little bit further to go. This past 2026, I think I talked about another previous
yeah,
cycle. End of 2020, end of the second year of the decade,
yeah.
usually runs up to the year ending in 5. So we typically have about three and a bit years of up at the beginning of decades. Which is crazy. It's got 100 years of data. We'll talk about that another day. I think
Yeah.
we've
And just one final point to mention is when
yeah,
that bear
sure.
market cycle begins,
Mm,
nobody, very few people will be expecting it. When that bear market cycle eventually starts, assuming we're correct, it's going to start not this year, following years.
of course.
Everybody will be super bullish. All major economists, major analysts, TV media, everybody was going to be super bullish calling for much, much higher levels. And if you and me say no, we're going to go into a bear market, we'll be absolutely ridiculed and trashed as crazy people. And that's how it usually is. But that's why most people are going to end up losing their money in that bear market cycle, because they're going to probably dip into the market, or no, they're going to come into the market in large volumes
Heavy.
at the worst
Yep.
possible time, and they're going to stay in that bear market cycle all the way through to the end.
Yep. And it's not like we're going to pick the exact top. It's just going to be
No.
things are looking a little bit shakier towards the end. But I think we've got plenty to discuss in future videos. Guys, thanks, Alessio.
Thank you.
Check out his links in the video description again. Mate, I really appreciate having you on the channel to discuss all things cycles.
It's my pleasure.
There's
Thanks,
very few
Jason.
people. Yeah, cheers. Very few people who get into it. So like it up. Check out the links. Thanks, Alessio.
Thank you.